Hi, this is Roger Balzer. Welcome to our 2-Minute Tuesday for October 18th of 2016. Our title for this week is Severe Equity Decline. In my conversations with prospects and clients, I've been hearing a lot of information come out about the Brexit, what's happening with this election, and what's the likelihood of a severe equity market decline. In this video, I'm going to walk you through my game plan for defensive preparedness, and we're going to take a look at where we stand today. My job, first and foremost, is to protect you and your investments from another 2008, whether it comes 3 months from now or 3 years from now. This slide here kind of gives you a succinct pictorial of my defensive preparedness game plan with the key signs that we take a look at. At first glance, you can see that the evaluation process involves both trend and leadership indicators and measurements. We're going to take a close look at each one of these 5 key points to evaluate how they looked in 2008 and how they stack up now. And I think what you'll find upon conclusion is that the equity picture remains decidedly bullish today. We have a couple areas of concern, but nothing of major trouble, and it's imperative that we vigilantly evaluate these indicators on a consistent basis to understand if the overriding theme changes from bullish to bearish. The first area we take a look at is the positive trend indicators below 50% level. Trend analysis is one of the cornerstones of our research here at Balzer Wealth. Simply put, the only way over time a stock or index can remain in an overall uptrend is by showing higher prices. And as an investment, this is how you are rewarded by higher prices. So it goes to reason that you should focus your investing on those stocks that are trading in an overall positive trend. And furthermore, the greater the number of stocks trading in an overall positive trend, the healthier the market is. We measure this by calculating the number of stocks in an overall positive trend using the bullish percent concept. By definition, the percent positive trend indicators are the measure of the percentage of stocks within a given universe that are trading in a positive trend. We then plot this on a point and figure chart with a scale of 0 to 100%. I found that the market is generally healthy when the percent positive trend indicators are at 50% or above. Generally speaking, the market tends to suffer during times when the positive trend readings are below 50%. Simply put, as the positive trend readings fall, it suggests more and more stocks are moving into a negative trend and showing lower prices. I'm constantly keeping a close watch on the positive trend charts to see how they're performing. Back in 2008, it was quite evident that the trend was deteriorating for many stocks as the percent positive trend slipped below 50% in early January 2008 and moved steadily lower throughout the year, reaching a low of 6% by October. It wasn't until May of 2009 that the percent positive trend for the New York Stock Exchange surpassed the 50% level on the upside. During this time, the Standard & Poor's fell 36% in 2008, and the S&P Equal Weighted Index fell 31%. But looking back prior to that, we saw from 2003 to 2008, the percent positive trend was above 50%, and the return was quite strong. As we turn to today, we find the percent positive trend for the New York Stock Exchange and all other major positive trend indicators are above 50%. In fact, the percent positive trend for the New York Stock Exchange moved above 50% in June, and today is at around 58%. What this means is that the trend picture for the individual stocks that make up the market is tipped towards a bullish camp. Another sign to watch for to indicate that the market is weakening is whether or not the bullish percents are showing lower tops. Now you may be wondering, what are bullish percents? To understand how the bullish percent works, you need to begin with and understand 3 main concepts. First, the bullish percent index merely measures the percentage of stocks currently on buy signals. It's simply a chart again that runs from 0 to 100%. Second, the only way that stocks can give a buy signal is to see a price increase. The only way a stock can be on a sell signal is to have a price drop. Third, stocks are either on buy-sell signals or sell signals. So another way of explaining the bullish percent concept is to say that when the percentage of stocks with buy signals falls, the percentage of stocks and sell signals is rising. The only way, again, a stock can be on a buy signal is to have a price increase, and a sell signal is to have a price drop. When you're having a price drop, this means more money is flowing out of stocks. This tells us that more and more stocks are giving sell signals when you start to see the bullish percent drop, and you need to begin focusing more on wealth preservation instead of trying to make as much money as possible in the markets. At Balzer Wealth, we follow bullish percents on all the major market indexes and sectors. Our main coach is what we call the New York Stock Exchange bullish percent chart. That's the one you see here. In the short-term perspective, we evaluate whether the New York Stock Exchange bullish percent and others are in a column of X's, which means offense, or a column of O's, which means defense. But from a more structural basis, we will evaluate whether the New York Stock Exchange bullish percent is showing a series of lower tops. If so, it suggests that more and more soldiers are leaving the field and are not participating in the market when it rallies back up. When we look at how things stacked up as we went into 2008, we noticed that the New York Stock Exchange bullish percent was showing a series of lower tops and had been since its peak in early of 2004. This was evidence that as the market rallied, even to new highs in October of 2007, it was doing so with less and less participation. In short, the participating leadership was getting narrower and narrower. Narrow leadership is not the sign of a broad, healthy market. As we look at where we stand today, we find that the market bullish percents are showing higher bottoms and generally higher tops at this point. Today, the New York Stock Exchange bullish percent is in a column of O's after it reversed down on October 12th. We will be monitoring this development to see if it breaks 50% or if it's what I call a pause that refreshes. Overall, it's important to look at other market bullish percents to see if similar action is occurring in other universes. We look at the small cap, NASDAQ, mid cap, and also the large cap bullish percents. At this point, we are seeing what I call a mixed picture. The bullish percent for all optionable stocks just turned to O's, meaning defense on Friday. The mid cap bullish percent is in O's, and the large cap bullish percent is within 0.5% of changing to O's. The lone bright spot is the small cap bullish percent, which is solidly in X's and not close to reversing. In a nutshell, we will continue to stay with the small cap area of the markets and monitor closely the other bullish percents, but this is one mark against the longer term bullish outlook. The third area that we take a look at is our defensive asset classes giving relative strength buy signals over offensive asset classes. At Balzer Wealth, we found relative strength to be one of the most robust and adaptable methods of security and asset class analysis. Despite being a very simplistic concept, relative strength is proven time and time again to be a practical methodology for outperforming the markets over time. Relative strength, as the name implies, measures how one security is doing compared to another. For example, how is Apple performing versus the S&P? Or how is Apple acting compared to Google? Much like comparing a stock against an index, I can compare an index against another index to determine the overall strength of a particular area of the market or asset class. It is in this concept that allows me to monitor asset classes for strength or weakness. I typically find defensive asset classes are giving relative strength buy signals over offensive asset classes. These defensive asset classes are lower beta and lower risk, such as money market, fixed income, as well as foreign currencies. Offensive asset classes are normally defined as U.S. equities, international equities, and commodities. The slide you're looking at here is from 2008, and we see in our asset class rankings that the defensive asset classes were favored over U.S. and international equities. Commodities were in second place, but foreign currencies was in first, while cash and fixed income ranked above U.S. equities, as those two areas continued to lose relative strength. The current asset class rankings that you see here show a different story from 2008. Today, U.S. equities is in first place, followed by commodities in second, as they continue to gain relative strength signals over the defensive asset classes. This is indicating to us that we are still in a strong bullish market. The fourth area that we take a look at are the trend charts of major indices turning negative and violating important support areas. Another indication of the deterioration can be found in the trend charts of what we call the major indices. If the trends of these important indices are turning negative with other violations of key support, it suggests a deteriorating market. You're looking at here is the Standard & Poor's 500 trend chart back in 2008. It turned negative after it violated its bullish support line in January. This shifted the posture of this index to a defensive one. As well, it coincided with trend changes across most major indices. Taking a look at this slide right here, this shows you back in 2015, we did have a breakdown at the circle early January of this year, which took us down. We had kind of a major pullback that happened in the marketplace. What you're seeing right now, though, that I want you to see is the breakout that happened, which is the green circle. We are in a major uptrend right now with the S&P 500. It's very positive, but a breakthrough of the support, which right now can be found at the 2110, 2120 area, followed by a violation of the positive trend line, which is the green line going across, would provide evidence suggesting a further decline. So it's something to watch out for going forward. Will be a change in the trend for the major indices, especially after what could be a market top. For now, however, there is no weakness on a trend basis for the S&P 500. The fifth area that we take a look at is the narrowing of leadership from individual sectors. We find that often market tops take time to form and also do market bottoms. But one of the initial ways to identify weakness can be done on the sector level, as the sectors serve as a small-scale version of the broader market. When we look back to the beginning of 2008, we found the evidence of weakness when sector leadership began to narrow. Notice in the graphic here that the market entered the year close to being skewed to the left, which means the market is in what we call oversold territory. As well, there are only 8 sectors that maintained a favored sector status. If we fast forward to today, we find ourselves in a market with a very different complexion. One with 24 favored sectors and very broad leadership. In addition, there were 26 unfavored sectors at the beginning of 2008, but today there are only 4. We're also in a more offensive posture with respect to the sectors than in 2008. Today there are currently 20 sector bullish percent charts in X's. In 2008 there were only 17. Going forward, we will pay attention to the sector statuses and their bullish percent charts to monitor any significant changes in weakness. If this weakness intensifies, the sectors are going to change to O's and we are going to have a challenging market ahead. However, right now, we are looking at a very broad leadership in the market, which is bullish for the marketplace. With all of that being said, we do have some cracks in the market right now, but the overall technical picture is still very, very extremely positive. I think what we're going to see coming up here is a little bit of what happened in early 16. I don't think we're going to get as much weakness, but I think we're going to see with the New York Stock Exchange pulling back a little bit, I think we're going to have some very meaningful bottoms that are going to happen here in 2016 and October of this year. And I think we're going to have some very, very good key entry points coming ahead here forward. Once again, if you have any thoughts, questions, concerns, please reach out to me. 440-610-3012 is the mobile. 440-934-3114 is the cell phone. And remember that any of the securities mentioned in this video are not a recommendation to buy or sell, and also do not represent specific recommendations of Balzer Wealth Management. If you're relying on a video for investment advice, you're making a huge mistake. Please consult with your investment advisor before you make a decision to buy or sell any investment. And if you don't have an investment advisor, I encourage you to contact us through our website or at the number you see here, 440-934-3114. If you have any questions on your 401k, please reach out to us again also. It's been Roger Balzer. Make it a great week.